We're going to be going live here. All right. Event URL. Copy the URL. Let me see here real quick.
Are we live now?
We are live now.
Excellent.
Let's share this to my story real quick. All right. And then, all right, good deal. Let me get one more thing here to make sure I can see what's going on. All right, we are good. We are good to go.
Excellent.
Let me pull back so I can get back at the comments so I can see if we have any comments here. All right. Good. Now we're rolling. All right. So sounds good. So loud and clear. You can hear me now. I can hear you. Sounds good.
All set?
We're all set. Let me make sure. Everyone can see you also when they. Boom. Yeah, we look good. All right. So we are here with Mr. Bobby Hughes in the First Time Homebuyers Club. So this is your first time on for the First Time Homebuyers Club. So welcome.
Thank you. Thank you for having me, man. Thanks for inviting me on. I appreciate it.
It should be good.
It's an honor.
Yeah, man. So we got the First Time Homebuyers Club here. I wanted to do this event here just for folks so they can check it out, watch it, and then they can come back to it. But you are the expert in home loans. And so first of all, just give everybody a little background on who you are, kind of what you do, and then we'll get into the topic because we're going to be talking about rising interest rates. What does that mean for first-time home buyers? And then I want to talk a little bit about the process when you get started, with a loan and all that. But let everybody know who you are, and then we'll kind of go from there.
All right. Well, Bobby Hughes, born and raised in the Permian, and kind of live and breathe out here, just like everybody else. We started out, came out in the oil field, spent 16 plus years in the oil field, so I know that aspect of it. Also a little bit of a business owner, investor, so I know that aspect of it, and been in mortgage for a few years now. So bringing my past experience from oil field and everything into this arena really helps out in understanding, because the majority of people out here are oil field. We get a lot of contractors, small businesses, self-employed people, so that my knowledge of that I think really lends to my abilities as a lender. I work with guaranteed rate here in the Permian, and I'm bringing the branch here, bringing guaranteed rate into the Permian, starting this branch up here, and we're really excited about the future. I think it's going to be an amazing trip, coming in the next several years. It's going to be awesome. So really look forward to it, and working with you too as well. It's going to be great.
We've done a couple of deals together, so it's been really good. I also know you as an individual, so I know you take care of business. The thing I like to point out is, you've been kind of around, as far as the loan process and real estate. You had some investment properties, and then you've also purchased a personal property. And so you've been through the whole process, from a retail standpoint, like buying a house to live in. And then also you've been through it as far as owning, investment properties as well. So I think that's like really key, when people are looking for a lender that they're going to work with, someone that has been through what they've been through, and you've been through it on both sides, because buying a house to live in and buying a house for an investment property as a business are two totally different things, and so I think that's really, really good. Tell us a little bit about guaranteed rate as well. What makes you all different than, maybe a couple of other lenders out there, just so people will know kind of the difference, because there are
Well,
differences between lenders, correct?
absolutely. So what I like to tell people is Guaranteed Rate is one of the largest mortgage companies in the US. We're in all 50 states. It's a massive company, but the branch that I work with is based out of Fort Worth, and they're its own little branch, managed all by itself. We control everything in our process that we do. So it's kind of like the best of both worlds. We have the big bank money and resources of this massive national brand, but at the same time, we have the management and the customer service of a small local bank. So it's the best of both worlds there. Guaranteed Rate is very into the high tech, new technology, modern mortgage experience. So we're on top of all the latest innovations, and when it comes to mortgage, the support that we have is incredible. The way they have things set up for the process throughout the process, and then any possible strange scenario that might come out, we have people that have experience and can dig into it quickly. So the resources are just phenomenal, and that's really the biggest difference between what I got and compared to any of the local banks here, or even the big national mortgage companies that you see all over the place. Is really is the best of both worlds.
Perfect. Well, let's get right into it. So we'll talk about interest rates here in just a second, but let's talk about, for a first-time home buyer, right? I don't know anything about buying a house. I've never bought a house. I've, maybe rented, or I've, been living with my mom and dad or my grandma or somebody like that. What is the first step? Obviously, the first step is to work with a realtor, and then a realtor is going to find a great lender like yourself. And so kind of explain that process. What is a person who is looking to get a loan? Like, what do they need? What are some of the things they need to be prepared for? And then how are you going to guide them in that very first phone call with you?
Well, you're right. The first step is to get a good realtor that you know and trust. And a good realtor is going to be able to introduce you to really good lenders, especially local lenders and things that you want for this area. So once you got some recommendations, when I get a referral from a realtor that comes in, first time home buyer, first thing I want to do is explain to them the process. A lot of it comes, there's so much confusing information out there on the internet. You can pull up 1,000 different websites and get 1,000 different opinions about what to do. So what I do is I break it down very simple to what the main questions that you need to ask. One is, how do I get pre-approved, and what is that process? And then the second question is, once I'm approved, how much am I approved for? So those are two completely separate issues, although everybody kind of wants to mix it all into one question. And then I break it down to, what does it mean to get pre-approved? What are the basic steps to get pre-approved? And there's four main components: your income and employment, your assets, your debts, and your credit. So once I break those four down, then it becomes a little bit more simple to understand how to get pre-approved. Now, once we get through that process, then we can look at, once you're pre-approved, how much is it approved for? We got to get through the first four first. So
I'm gonna stop you right there. So that you said the first four things are what? You said your
income and employment. So that
okay.
tells us your ability to pay a monthly mortgage,
Okay.
and all your other debts and living expenses. So your income and employment gives us your monthly income, and then your assets, like
What on income? So on income and employment, what are the requirements there? Because normally what I tell folks, right, when I send them to you, I usually, before I even send someone to you, I normally ask them, I say, well, how long have you been employed? And so what are the details on that? Is there a certain amount of time that they need to be employed? What if somebody's a student? Do they have to have employment history? Kind of break that down for them.
So first thing we look for is 2 years of work history or some sort of history. And as a student, if let's say somebody's fresh out of college, this is their first real job, but they've been in college for a few years, we can use your college transcripts to show that you've been busy doing something. You have experience. You've kind of paid for your experience in your student in your college education to get to this point. So we can use student time as employment time, similar. But we always look for 2 years worth of history of some sort. There can be gaps. You can change jobs. There's kind of a limit as to how many within a year you can change, but you can change a few times a year, because some people bounce around. 2020, 2021, people were bouncing all over the place trying to land something, right? So, but it can happen. You can also have a gap in between certain points, and we can address those situations as we get to it. So
yeah, so really the best thing is, if someone's thinking about possibly buying a home, they just need to get with you on the pre-approval process, because some of the common questions that I get, and also if you're on live with us now, if you do have a question, you can put a question in the comments. I'll see it and I'll ask Bobby the question. But kind of the question is like, yeah, if I do, because of COVID or whatever else, if I did like have a time frame or a loss in employment, is there an actual hard and fast line? Do you know what that hard and fast line is? If I can I be out 6 months or 5 months or 2 months, or is there a number, or do you all gauge that on the whole person?
There is a kind of a number. So let's say, like, for FHA reasons, because they're going to be a little more strict on it. For FHA reasons, if you have a gap in employment of 6 months or more, then they want you to be at your current position for at least 6 months and your current employer. So, if you've been at a job for several years, and then there was something happened and you were out for 6, 7, 8 months, well, then you get a new job, you're going to need to wait 6 months before we can even get you started under contract.
Okay.
Now with conventional, you want to be 6 months, but we can work that throughout in the process and stuff. So if you think about that, anything less than 6 months, then we just need to document, what the gap was for, what happened, and then there's not too many stipulations as far as that goes. Cool. Now let's say if you did have a gap longer than 6 months, we'd have to go back 2 years before the gap and document 2 years of work history before the gap, so that we can, because it's all about how are we going to say that the new job that you have now is stable and going to keep recurring. So
right, because the main thing you all are trying to make sure is, and the reason why the guidelines are there is to make sure, hey, this person is going to be able to, you don't want to put somebody in a bad loan or a bad mortgage. You want to make sure they're able to pay it. So the other question that often, or issue I see come up is that I think you can maybe talk to on income is like W-2 versus 1099 versus, and then maybe talk about like overtime and what's on your tax return, I guess you could say. So how can folks know like what's actually going to be used for income, and then 1099 versus W-2?
So the difference between 1099 and W-2, with W-2 job, you're an employee. It's pretty standard, easy to qualify. If you have 1099 income, then that falls under self-employment. That's a whole nother issue, and I'll get to that in a second. If you're W-2 and you get an hourly rate, you got your base pay. We use gross, so not just the paychecks that you get, but before taxes and deductions and all that. So let's say you have an hourly rate. We use that as your base pay, but then you also get overtime or commission or bonus. The overtime or commission or bonus needs to have happened fairly consistently for the past 2 years. Now, if you have changed jobs, we can still use it if it was consistent and the job was the same job, same industry and everything. So it's kind of an even field. We can still use it. But if you go to a different industry, that time starts all over. And you got to wait 2 years before we can use the overtime again. And that goes for overtime, commission, or bonus. So when it comes to, the W-2, that's what you need to think about is what's your base pay, and then anything else needs to have a 2-year history of being consistent. So, and then at that time, we take the last 2 years and we average it out. So once we average out that income, it's not just about what you did, past few paychecks and what you're doing now, because a lot of people are getting great overtime now, but they didn't get so much in 2020. So once it averages out, what is that income going to be? Now, when it comes to 1099, any kind of business, small business, or if you're a contractor and you get 1099, then that falls under self-employment. And with self-employment, we need 2 years of full tax returns. So it's not just about, whereas W-2, we go back 2 years from the day that you put in your application. With self-employment income, we go back to the last 2 full years of tax returns to average those out. And then there's a big calculation involved with which numbers we use and what we can add in, add back, because we can add back depreciation, things like that. But it depends on how you set your taxes up. Someone who let's say you were just starting a new business, or you're a contractor, you just started, then, the year's already in April. So we got about 8 months left in the year. You're going to want to be in that job for not only through 2022, but also a full year of 2023 and a full year of 2024. And then whenever you sign up your 2024 taxes, when you file your 2024 taxes, then we can look at what you've done over the past 2 years. So when I look at 99 now, I'm looking at what was the last 2 years of tax returns looking like. What does that income show for those?
Yeah. And usually where I see people get in trouble if they're a business owner is they write everything off, right? And so if you're thinking about buying a house, unfortunately, you'll probably end up paying more taxes, but you've got to be able to show more income to the lender in order for you to be able to purchase a home. Because some folks run into that problem. It's like, man, I make a ton of money, but then on your tax return, it shows like, you don't make any money, even though you make a ton of money. So you have to play the game in order to get approved for a home, essentially.
Yeah, exactly. Any good accountant or CPA for a small business is going to write off everything they can and get you to pay the least amount in taxes. But it's an inverse, so we need to show you making as much in taxes so that we can get you into the home, but the CPA wants you to write everything off. So we're always fighting with that. I know some people that will call me up and we'll create a plan for the next year or 2 years so that their income tax can show, what they actually, can afford and get into a house. So I can kind of help guide a little bit. I can't tell you what to put in there, obviously, but I can help guide a little bit on what what your taxes need to show in order to get into the home that you want to buy.
Yeah,
exactly.
So
a little bit of guidance goes a long ways.
Which is really important for people right now, because folks, if you filed an extension, obviously then you probably are doing your taxes and stuff right now or whatever. So I think that's pretty good. So number 1 is income. And then what's number 2? What was number 2?
Number 2 is assets. So with assets, we're looking at bank statements, retirement accounts, 401k, maybe some stock trading accounts, things like that. What we're looking for is liquid finances to cover the down payment, closing costs, and prepaid. So the out-of-pocket costs for purchasing a home. So where's the money going to be coming from to purchase the house? And in the mortgage world, cash is not king. So when it comes to buying a home, you can't just throw a bunch of cash at it and get a mortgage. We got to verify where the money comes from for guideline reasons, regulation reasons. It's against the rules for the seller to come around and give you money to purchase their house for their down payment and stuff to show that you have money. So we got to verify where everything comes from. So
And
we
when
look
you say verify where everything comes from, because this is a big thing that comes up with a lot of my clients as well, right? So they're like, man, they want to know where I put all my money at. They want to know this and that. They don't need to know all that information. Well, what you're saying is you need to be able to verify it. So what does that actually look like? Because a first time home buyer doesn't know what that means. So I'll kind of tee it up and then you can tell what that actually means. Because what I kind of see is like, somebody says they want to buy a house and then, it's like, oh, well, I'm going to go put this lump sum of money in my bank account that over here in my crypto account or whatever else it is, like a, 20 grand or whatever else, and so explain like how you need to be able to see where that comes from and where it goes and all that.
Yes, when it comes to, if somebody has the money in the bank, like say a savings account or checking account, we'll get the past 2 months of bank statements to look at to verify the money is there, it's theirs. It wasn't just, given to them. And what we do is we look at the deposits. That's the main thing we look for is large deposits of say $1,000 or more. We always find the pay stubs, and those are easy to verify. It comes across as like a payroll check or something. And we have pay stubs to verify that. Well, if there's another deposit in there of, say $3,000 for just a mobile deposit or just a deposit, we have to verify where that money came from. We got to know that for sure that it did not come from the seller or somebody that's involved with the transaction. So when we look for that, we always ask for documentation, a canceled check or an invoice or something to show what that was for. This time of year, people are getting tax returns. So you get a big, deposit of a tax return, and even though it says, IRS or Treasury or something like that, we still got to have a letter from the IRS saying this amount of money was returned as is their tax return, and then it matches up, and we verify it. So it is kind of invasive. It gets very personal when you're talking about finances. But we're not looking to see where you spend your money at or where you have your money or any other thing like that. And we don't share this information with anybody else. This goes into the file, secured into the file and simply there to verify where the money's coming from.
Yeah, that's really good. That's what I think it gets confusing to a lot of people because let me ask you this, is it almost better for someone to have like one bank account for like their payroll? Say like, I just have this one account and my money always, from my employer always goes into here. And then maybe have another account where you do like, cause a lot of people are doing different stuff now, they're doing like, Etsy shops or they're doing like crypto stuff or doing other stuff. Is it better to have your accounts separate and would that make it easier or does it not matter in general? You just need to know where things come and go.
We just need to know where things come and go. So we see that a lot pretty often where it's all going into one checking account and they're driving for Uber or Lyft or something like that. And, they get, or like you said, Etsy or you got little side gigs going on. And there's just a lot of deposits. We see a lot of deposits from, Venmo or Zelle or something like that, where it's just random money coming in. Now, the smaller deposits, no big deal. But when they get to good size, we got to verify it.
So it's really the big deposits that really are the thing
Right.
that are out of the norm. A big deposit that's like out of the norm.
If you look at somebody's bank account, money goes in and out all the time.
Got you.
But it's the big accounts. If somebody got a few $100s from someone, well, that's not going to impact a home purchase that much. So we're not concerned with that. But if somebody got 1,000 or 1,500 or 2,000, like, okay, we got to verify that's not coming from somebody in the transaction. So to your point, would it be better to have separate? If I get one pay stub that shows the money coming in from your payroll, and that's the only money we're going to be using for income, and then it's real simple, I would love that. That would make everything way more simple. So
sure.
If they did that, yeah, but they would have had been doing that for a few months because we're going to go back 2 to 3 months.
Yeah. So you need like a quarter of deposits, basically 3 months out, 4 months out.
Yeah. Yeah. Cool. So if they set that up, and they wait a few months and all we see is payroll check coming in and then some basic, general expenses, then yeah, that would be awesome.
Cool.
It
And then the
keeps things
next,
nice and clean, but so many people can't do that. They have one paycheck, or one bank account, and that's where everything comes in and out of, and
yep,
they spend it and use it as they need to.
right.
So
So the next thing you said is you got to make sure that someone didn't give you the money for a down payment. So explain that. I can't get money from someone else for a down payment, or what's all that about?
that's a good question. Let's clarify that a little bit. You can get a gift from a family member or an employer for down payment. You can get or down payment and closing costs. You can also get the seller can offer to pay for some closing costs. There's a certain percentage, a certain amount that they can use, but they can pay for it in the contract, and it's coordinated through the process of the mortgage. But they can't just go and give you cash to go buy the house.
Perfect. Yeah.
In that process, there's verifications, but yeah, you can't just get money to go buy a house. There's a process to verify and document. You got to think anything that goes into a mortgage, anything that we use, is going to be verified and documented every step of the way. So you can get a gift, but there's a certain process to that. So it's better to not just take money and to coordinate things with your mortgage lender as to what the proper steps are.
Excellent. And then what's next? So we got income, assets.
And then it'll be your debts. Your debts and your credit all come from your credit report for the most part. So a credit report is more than just about a credit score. It shows a ton of information that we can use. It verifies a lot of information that we need, and it brings in the debts that we need for what's called the debt to income ratio. Now we'll get into that in a little bit, but your debts, when I talk about debts, I'm not talking about utilities and expenses. I'm just talking about credit card payments, auto loan payments, other loan payments, mortgage payments, things like that. So those debts we have to account for when we account for your debt to income ratio, when we look at getting approved and how much to get approved for. So the debts really is a good indication of how much room do you have in your income and your monthly income compared to your monthly debt payments. How much room do you have for another mortgage? So that's how we get to where, how much are we approved for? How much house can we afford? Because it all comes down to how much money is coming out of your pocket. And then we need enough room in there for regular living expenses.
Okay, perfect. The question I have on debts then that a lot of people ask, are there any debts that will like automatically disqualify you? And then what about, because a lot of folks have medical bills, right? Do medical bills count against you? What is that? What's
medical bills do not count against you at all. They actually, when they come across on your credit report, we remove them from the credit report altogether. They're not allowed to be used in the qualifying ratios. Now they can impact scores. There's nothing we can do about that. But for your debt profile, we remove those altogether. Student loans can come across. Sometimes they come across as deferred or zero balance. A zero payment, but we have a calculation to use depending on the loan program so that we can account for that. Because eventually you're going to have to pay for that. And we got to consider the debts that are going to be happening in the future as well. Now, when you have say you have a federal debt that's derogatory or disputed, if you're on FHA, because FHA is a kind of a federally backed loan, those debts have to be paid in full or at least on a approved IRS payment plan before we can go forward with the loan. So that's one indication of something that we'd have to take care of before we do anything. For the most part, everything else can be used.
Is that also the case with like child support too?
Yeah, child support. If you have back child support that you owe, you may have to get that updated and paid in full and brought current. It's not, child support we can document just as another debt. If it comes across as old or back child support that is due, that will have to be brought current.
Excellent. And then the next question is on like credit scores. So do you all, a lot of folks are, I talk to some people and they're using like Credit Karma or something like that. And sometimes, I think the credit score is accurate, but a lot of times it's different. Do you all use a different like gauge, kind of like, with cars, if you use Kelley Blue Book and then you go to get your car evaluated, they're like, oh, we don't even use Kelley Blue Book. So like, do y'all use the same thing for like credit and all that, or what's the deal with, what's the scoop on credit scores and all that?
So like what you're asking, what's a good way to monitor the actual scores that we use?
Yeah, my question is because a lot of folks I talk to, I'll ask them if they know what their credit score is, and they'll be like, oh, I got like a 620. And so my question is Credit Karma and, all those little things you find online, are those accurate? So can people take that to the bank when they come and talk to you like, oh, I got a 620 on Credit Karma, and then you check it and it's like, oh, they might have a 500 or they might have a 720, so what, is there a difference in that?
So when it comes to Credit Karma, Credit Karma uses, I believe it's a FICO 8 score, which is just a consumer score. And there's a difference between a consumer score and a mortgage score. A consumer, they calculate things different. They take different things into consideration. So the scores are different. Now, the Credit Karma is a good kind of free way to see a trend. If you see it going up or down, it's pretty neat that way. But it's not the same scores that we see. Oftentimes, more often than not, we're 20 to 30 points lower than what your consumer report's going to show. I've seen them as low as far as 100 points off compared to what the Credit Karma was showing. So if you're looking at Credit Karma and you're at a 650, we pull something, we could be closer to a 620, 630. If you're thinking you're in the 700s, you could actually be in the 600s.
Gotcha.
But you can see the trends going up and down, and it's a good indication that's probably what's happening with your mortgage scores. Now if you want a really good one app that I always tell people about is MyFICO. So the MyFICO app is the exact same scores we see. It's the mortgage scores, and it's a monthly charge. I'm not sure what the charge is, but that's one that I always recommend and is highly recommended to anybody that's really looking for it. And what I tell people is like, if you're looking to build your credit up, watch the Credit Karma or whatever it is you're using. When you see it get up to a certain point, look on MyFICO and pay for that charge, and you're going to see exactly where it's at. And if we're ready to go, we're ready to go. If not, then exactly how much further we need to go.
For sure. And I think you could check you get like like one free report a year or something like that. So yeah, check it with Credit Karma or whatever, check your trends. But the key point is that I'm trying to get across.
That's just a credit report. That's not a credit score.
I got you. Well, my key point that I'm trying to get across is just like, when I talk to somebody about their house, they're like, well, Zillow says my house is worth, $1 million. And I'm like, well, I'm an agent and I look at the market every day and your house is worth, $5. So my point is like, find an expert, like go to the expert to figure out what you need to do. Right. Exactly. So that's really good info.
The best thing really is if you're really interested to figure out where you stand, talk to a mortgage lender. We'll get you the actual scores. And a good lender will be able to, if you're not ready, if the scores need a little bit of improvement, a good lender will be able to give you a game plan as to what you can do to get your scores up and give you a kind of an estimated timeline as to how long that would take, which is what I can do. I always give my people a game plan, say, take these steps, and in so many months, your scores will be above, whatever it needs to be, whatever we're looking for. And then you'll come back and we'll keep an eye on it.
Yeah, that's exactly right. And so that's really the key I want to get across to people, because, that's what happens most of the time. Somebody's like, well, I'm not really ready. And I'm like, well, you should still go ahead and speak to the lender, because if, for one, let's say you have something on your report that you didn't even know about. For one, it's like that should be taken off, could be hurting you, and you could already be ready to be approved. And then two is, you can tell the person what they should do, because there's certain stuff you can take off that'll hurt you, there's certain stuff you can't, and all that. So that's why they need to speak to, you or a lender as the professional to actually get guidance on that. So, don't, my point is don't wait until you're ready to buy a house really to speak to a lender. You should be speaking to the lender way beforehand to get prepared, to buy a house.
If you're already talking to a realtor, then you need to talk to a mortgage lender too.
Exactly.
Get a game plan. It's never too early to talk to a lender.
Exactly. One last thing with that. One reason why folks, or one thing that I hear why folks are scared to talk to a lender is because they're like, well, are they going to pull my credit? And they're like, well, I don't want them to pull my credit yet, and so maybe explain, about pulling credit, soft hit, hard hit, or whatever, people need to know about that. And does it affect your score and all that?
Okay. Yeah. And I get that a lot too, is people are scared to get a hard hit on their credit report. And what I tell people is like, even though a mortgage is a hard hit, it really comes down to how many credit pulls have you done in the past, couple months. Because if you haven't done anything and we pull credit now, it's not going to affect anything. You just pulled a credit. But if you have, been looking at opening credit cards and you try to get an auto loan and now you're getting a mortgage, so you have 3 different types of credit reports being pulled fairly close together, that's going to bring your scores down, because then it shows, oh, this guy's, just hunting for any kind of finance they can. So that's when it has an impact. Only if it's a bunch of them all together, in a short amount of time, that it has an impact on you. One credit pull is not going to do anything. And
Excellent.
then once we do pull it, it's good for, I think 4 months, so we shouldn't have to pull it again unless we need to extend a little bit, and then we pull it again. But at that point, it's 4 months later, so a hard hit, it's only bad if you got a bunch of them.
Got it.
All together.
Perfect. So does that hit all of them whenever we apply income, assets, debts, and your credit report? Is that it?
That pretty much covers the basics of what we need for a pre-approval.
Right. And then when they get the pre-approval, what does that look like? Are you going to talk to them on the phone? Or are you going to send them a link to an app? What do they have to download something? What do they have to do?
Well, to get started, when they first call me, I always give them a link to my applications. They can do it online. It's fairly simple, fairly quick. And then once I get the application in, I review their file, and then I go over what we need. So I make the list of documents that we need, like, income, employment, the bank statements, whatever is depending on what their file profile is. I'll make this list, and we go over verifying all the documents and cover. That's when I make the call. It's what I call the mortgage consultation. I go over the file, go over the documents, go over their goals. I want to know what their goals are, what kind of house they're looking for, what's their plan. And then we create a game plan from there, and a clear mortgage plan in order to get them to achieve their goals in the best, easiest way possible. So that's essentially the gist of it. You got a first call, fill out the application, and you got a second call or meeting to cover all the options involved. And then you're ready to go. Once you're ready to go, I send you back to the realtor and you go find a house.
It's really that easy. Upload your stuff, talk to Bobby, and you'll be ready to go. All right. So I got a question here from my lovely assistant, Ashley. She says, is it true that you can dispute credit inquiries if you do not end up utilizing that credit line?
So clarify, if you're not using it, you won't need to dispute it. But if you have a credit that you don't agree with, you can dispute it. There's, depending on how it comes across on the credit report, depends on how we need to address it. If you have disputed accounts that a few $100s or less, we don't worry about those. We just kind of kind of turn an eye on those. But if there's $2,000 or more in disputed accounts, then we have to address that and see what type of account is it and what's the payment. Is there payments being made? If there's not being made, then we need to calculate what a payment could be if you ended up having to make those payments again. So there's different ways to address disputed accounts. And also,
the question here's the question she's asking. Let's say, like, if you go, what we were talking about earlier, like if you go and you're buying a car, right, and then they like run your credit like 5 times, and you don't end up buying a car, can you dispute those inquiries, I guess is what she's asking.
no, there's no way to dispute inquiries. They are what they are.
Okay.
It doesn't come, as long as you don't buy the car, it doesn't come across as a trade line. It just shows an inquiry on the account. And that could affect credit scores. There might be a way to dispute the amount, because I've had that happen to me at an auto dealership. They ran my credit report 4 times. I didn't do anything about it. I don't, that's the only thing I was looking for at the time. So I was just going to let it be, and it faded out, because they get removed after a certain amount of time. So.
Gotcha. The key though is if you're looking to buy a house, you really need to put everything else on pause, right? That's why there's a running joke with realtors. It's like, hey, you're under contract on a house, and then it's like, hey, my buyer went out and bought a boat, or they went out and put a whole bunch of furniture on a credit card, and it's like, hey, dude, you shouldn't have done that, because now you don't qualify for the loan. So that is a really good question. So if you're thinking about buying a house, you really probably want to put everything else on pause until you kind of get this worked out, and then move forward with the other stuff that's going to deal with your credit and kind of all that stuff.
Oh yeah, all the way up until you close on the house.
Exactly.
You don't want to go a week before closing and, like you said, go out and buy a whole bunch of furniture on credit, or go open a new credit card, to buy the furniture, because it's going to pop up. We get automated notifications when something new happens. You definitely don't want to go out and buy a new car, unless you just happen to have a ton of room in your debt to income ratio, which rarely people do. So,
cool.
Yeah, I always tell people, don't spend any more than $1,000 without talking to me. Don't put anything on your credit. Don't let anybody run your credit until we get done with this process, and then you can go do whatever you want.
Exactly. All right. We're moving on a little bit on time here. So let's talk a little bit about like the elephant in the room that everybody's talking about right now, which is interest rates, right? So let me know kind of what, maybe tell us what has happened with interest rates from the beginning of the year, from your perspective as a lender. What do you think is going to happen in the future? And then how do rising interest rates affect, buyers and first-time home buyers specifically?
Yeah, it's quite a bit of a hot topic now. A lot of people go straight to the credit score, or not credit, interest rate topic. And really it comes down to the last 2 years. The reason why, we're in the 5% interest rates. So the reason why that seems high is because last year we were in the 3s. That's the only reason why it seems high, really. If you look at the last 2 years, we're at historic lows. It was incredible. Everybody was loving it. It was amazing. But now we're back in the 5s. And I got to tell you, 3 years ago, in 2019, is when I bought my house. I got a 5.25, and I was happy, because that was the way it was going. That was the market at that time. And if you look 10 years, the past 10 years, it's averaged, 4.5, 5, I guess, something like that. So really, we're coming into what a regular market would be. The last 2 years, you got to think, we went through COVID, we went through a pandemic, and everything dropped. Interest rates dropped so that we can kind of get this economy moving again, keep moving forward. And now we're coming back up out of that. So when people are concerned about interest rates rising and they're going up, getting crazy, that's because they're only looking at the past 2 years. Which isn't really a fair judgment on what interest rates have been doing. Now we're back up to, in the fives, which was, I think it was 10 years ago is when we're, up this high. But, uh, if we're springing up, it's going to eventually come down and kind of level out for a while. I don't know how high. There's no telling how much higher. They're talking about, the Fed's talking about more rate hikes and stuff. So it could get a little bit higher. And if that's the case, you have three options. One, you buy a house now, because right now is probably the best it's going to be for a few years. Uh, or you don't buy a house and you keep renting. Well, if you're thinking about that, let's say you're getting a house and you're looking at 5.5%, 6% on an interest rate. Well, what's the interest rate on renting? That's 100% right there. I've already got over $20,000 in equity in my house that I bought 3 years ago, and I bought it at 5.25%. So you're still able to build wealth, still able to get into homes, and still able to make those payments just fine. It does affect the DTI. It does affect the ability to pay. So yeah, I'm not going to say it doesn't affect it, but it's not as big of a problem as everybody seems to think it is, simply because most people are only looking the last 2 years. Does that make sense?
Oh yeah, 100%. It makes sense. It makes sense, and if you're listening to this on the replay too, I want you to comment. And if you have any questions or anything, I honestly think it's an issue that people should not even be thinking about, because, if you're, I think it depends on your situation. Right. And so if you're renting, I can guarantee your rent's going to go up. You know what I mean? So your rent's going to go up no matter what. So the question is do you want to go ahead and try to purchase a home, or do you want to pay more in rent? Because interest rates are going up and rents are going up, and what I would say is rents are probably going up more than what your interest rate is going to go up on your house, and so that's really my advice to folks. I think what it comes down to is people they get frustrated with the process, and they see all of these negative factors that are going on. But you're really better off to, whenever it's time for you to purchase a home, you should purchase a home. You should not try to time it, is my point.
When you're ready,
obviously,
you're ready.
exactly. And that's kind of the thing. If you're investing, it's a different thing. Investors have different mindsets, but when you're buying a house to live in, when you're ready, you're ready, and so maybe explain this to folks, because a first time home buyer, what does it mean? What is maybe the difference in payment? Like, let's say we go from 5% to 5.25% to 5.5%. Do you know those numbers off the top of your head? Is it like, give me a range. Is it like $100? Is it $500? Is it $20? What's maybe the difference?
That comes down to the size of the loan that we're doing. So 5% on $100,000 loan is completely different than 5% on a $300,000 or $400,000 home. So, but if you're changing, from a quarter, you go from say 5 to 5.25 to 5.5. You're talking about maybe, I want to say, $50 a month, something like that. So it's not a deal killer. It's not, well, and it depends on your situation. There's going to be those people that are riding that line where it's a yes or no. But when it comes down to it, if you're in a good position and you've done your work, to be prepared to buy a house, then $50, $100 shouldn't break the point where you're not going to buy, where you'd rather rent than buy, because your rent's going to go up $100 next year if it, you know what I mean?
Exactly. And that's kind of my point is, we hear like, oh, interest rates went from, 3 to 5%, or, whatever, from 5 to 5.25. Well, you need to be able to evaluate what that is, because it's like, oh, well, I'm going to wait. Like, interest rates went from 5 to 5.25. I'm going to wait 2 years before I buy. And it's like, dude, you're talking about $20, man. You're talking about $30. And they're like, well, I'm going to sign another year lease, and they go up $200 on your rent. You know what I mean? So, just to kind of help people quantify, that, which goes to tell you, if you're thinking about possibly holding off, you should still talk to a lender just to figure out what is actually going on, because you make the best decisions when you have the best information, right? And you need information. Exactly. You need information from an expert in order to do that. And, getting info from, Credit Karma and Zillow and all these other, apps that are out there is just not the way to go. So
Let's say you lock in an interest rate and you're at 5.5 right now or whatever. Well, a few years from now, if you're waiting for it to go down, a few years from now it can go down and we can refinance you into a lower rate, lowering your payment. So you're locking in now. So unlike rent, you're not going to move. And then we lower it when the rates get lower. We refinance you and very little out of pocket costs, and you lower your rate, lower your monthly payment that way.
Yeah, that's a really good
At the
point.
same
I
time,
haven't
you're
been telling
building
people about
equity in
that.
your home. You know.
Yeah, that's a really good point. I refinanced. What did we refinance a few years ago? So yeah, if you have a higher rate, then you get a lower rate, you just refinance. That's a
Yeah.
really good point.
So if you think about that right now, it's either rates are going to go up and they're going to go up forever and ever, which is not going to be the case. But people are freaking out thinking that it's never going to come down. Well, okay, lock in now. Let's buy a house now and get you what's going on now. Because if you're ready, like you said, if you're ready, you're ready. And then if it does go up and never comes back down, this is the best it gets, then you just locked in a great rate compared to what's going to happen in the future. If it comes down, we refinance you and you get a better rate. Same house, same equity. You already building more equity, and you're good to go there. So waiting 2 years to buy really doesn't make sense because you're going to be paying either rent or mortgage. So unless you're living with parents and you don't have a mortgage payment, even then, get in while you can. When you're ready, start building equity, and then you can create a plan to refinance into a lower rate later.
That's exactly right.
Mm-hmm.
All right. Well, that's really about all I had. Is there anything that you think I didn't ask, or you think people need to know, or like a first-time home buyer needs to know that we maybe didn't hit?
I think we covered quite a bit of it. One thing I want to reiterate is, it's never too early to talk to a realtor or lender. If you're even thinking about it, give us a call and we'll start getting a game plan. I know people that, called me last year, they're still working on getting some things together, getting their credit scores up to where they need to be, and they're almost ready to buy a house. When they're ready, they're ready. So if you're thinking about it, call the professionals, get a good game plan, get a good guidance on what's really happening, what really needs to happen. And then we can get you there much faster, easier, and cost effective than if you're doing it on your own.
Yeah, that's really, really good. And then what I would say is just get involved in the group that we've got here. Ask your questions. You can tag if you got questions, lender questions. You can tag Bobby in a post or whatever to ask him a question, or you can just reach out to him and do that. And I think there's other lenders in here as well. So just ask the question just so you can get the information there. And then we also have some recent success stories in the group too, which is really cool. So,
Yeah.
The one thing we'll get you on, we'll do this on the next call, but we'll talk about, down payment assistance, first time home buyer programs and all that stuff. We'll do that on the next one, but I think that was good for now. So like I said, you guys stay tuned, ask your questions. If any questions come up, put them in the comment box. We'll look at that and we'll check them out. And then we will catch you guys on the next interview we have here. So we appreciate it.
Excellent. Thank you very much, Jacobe. I appreciate you bringing me on.
Yeah, man, did an excellent job. Appreciate you.